If you're watching this, you probably know you should be investing. You've heard the stories, you've seen the charts showing that if you'd invested $10,000 in an S&P 500 index fund 10 years ago, you'd have over $30,000 today. You know compound interest is powerful. You know time in the market matters. But knowing you should invest and actually knowing how to start are two completely different things. And here's what nobody tells you. Most investment advice you'll find in 2026 is written by people who already have money for people who already have money. It assumes you have $50,000 sitting around to get started. It assumes you don't have student loans or credit card debt. It assumes you understand terms like asset allocation and tax loss harvesting and dollar cost averaging. This isn't that. This is investing for people starting from zero with real constraints in the actual economy of 2026. Before we go any further, I'm not a financial advisor, and this is not financial advice. This content is for education and entertainment purposes only. You should consult with a qualified professional before making any financial decisions. Now let's get into it. Let's start with why so much investment advice feels useless if you're actually starting from scratch. Most investment content in 2026 falls into two categories. First, there's the financial influencer content. These are people telling you to invest in crypto, day trade options, buy dividend aristocrats, open a Roth IRA and max it out immediately, build a real estate empire and start 3 side hustles. It's overwhelming, contradictory, and designed to keep you watching videos, not to actually help you build wealth. Then there's traditional financial advisor content. This is designed for people in their 40s and 50s with established careers, 401ks already running, and 6-figure incomes. They're talking about tax optimization strategies and rebalancing portfolios. If you're 25 with $3,000 to your name, this might as well be in a foreign language. Neither of these addresses the actual question most people have. I have some money saved. I know I should invest it. What do I actually do, step by step, starting today? Here's the truth that cuts through all the noise. Investing for normal people in 2026 is simpler than the financial industry wants you to believe, but it requires getting a few fundamental things right in the correct order. And most people get the order wrong, which is why they either never start or start in a way that sabotages them later. So let's build this from the ground up, in the right order, with the real constraints you actually face. Let's address the thing nobody wants to talk about first: debt. If you have credit card debt, personal loans, or any debt above 7% interest, we need to deal with that before you invest a single dollar. Here's why. Let's say you have $5,000. You're debating, should I invest this or pay off my credit card debt? Your credit card is probably charging you somewhere between 20 and 30% APR. Let's say 24%. That means your debt is costing you $1,200 a year in interest on $5,000. Meanwhile, the S&P 500 has historically averaged about 10% annual returns. On $5,000, that's $500 a year before taxes. You're paying $1,200 to borrow money while hoping to make $500 by investing. The math doesn't work. You're guaranteeing yourself a loss. Paying off high-interest debt isn't just smart financially, it's actually your highest return investment. Paying off a 24% APR credit card gives you a guaranteed 24% return. Show me an investment that guarantees 24% returns with zero risk. It doesn't exist. So here's the rule. Anything above 7% interest gets paid off before you invest a single dollar. Credit cards, personal loans, certain auto loans, these go first. Now, student loans are more nuanced. In 2026, federal student loans are around 5 to 6%. Some people have refinanced lower. If your student loans are below 5%, you can make an argument for investing while making minimum payments. The expected return of investing, around 10%, exceeds the cost of the debt, 5%. But this is a personal decision based on your risk tolerance. Car loans at 4 to 6%, similar calculation. You could go either way. The point is, high-interest debt is an emergency. Everything else is a choice with trade-offs. Once you've handled the true emergency debt, the stuff above 7%, then we move forward. Next question, before you invest anything, how much cash should you keep? You've heard 3 to 6 months of expenses for an emergency fund. That's correct, but let me make it more specific for 2026. If your monthly expenses are $2,500, you need $7,500 to $15,000 in cash before you start investing, not in a checking account earning
earning nothing. In a high-yield savings account earning 4 to 5%, as of early 2026, you can find these rates at banks like Marcus, Ally, American Express Personal Savings, and others. Why this specific amount? Because life happens. You lose your job, your car breaks down, you have a medical expense, your laptop dies. If you don't have cash to handle this, you'll be forced to sell investments at the worst possible time, usually when markets are down, and you'll pay taxes and penalties if it's in a retirement account. Your emergency fund protects your investments by making sure you never have to touch them in a crisis. But here's where people make a mistake. They save too much cash. I see people with $40,000 sitting in savings accounts afraid to invest because they want to feel secure. If you have $40,000 in cash and your expenses are $3,000 a month, you have over 13 months of expenses saved. That's not security, that's fear, and it's costing you. With inflation at 3% annually, your $40,000 is losing $1,200 a year in purchasing power. Meanwhile, if you'd invested $25,000 of it, keeping $15,000 for emergencies, that $25,000 could be growing at 10% annually, $2,500 a year. The opportunity cost of over-saving in cash is enormous. So the rule, 3 to 6 months of expenses in high-yield savings. Everything beyond that should be working for you in investments. Now let's talk about what most beginners do wrong once they start investing. They chase safety. You open an investment account and you see options. Stocks, bonds, money market funds, CDs, balanced funds. You're scared. You don't want to lose money. So you pick the safe option. You put everything in bonds or a conservative fund that's 60% bonds, 40% stocks. Here's the problem. In 2026, if you're under 50, this is the wrong move. Let me show you the math. Over the last 30 years, the S&P 500 stocks returned about 10% annually. A 60-40 portfolio, 60% bonds, 40% stocks, returned about 7% annually. A 100% bond portfolio returned about 5% annually. That might not sound like a big difference. 10% versus 7% versus 5%. Who cares, right? Wrong. Here's what happens over time. $10,000 invested for 30 years at 10% stocks, $174,494. At 7%, 60-40, $76,122. At 5%, bonds, $43,219. The difference between stocks and bonds over 30 years is $131,000 on a $10,000 investment. That's not a rounding error. That's life-changing money. But stocks are risky, you say. Yes, in any given year, stocks can drop 30%. It happened in 2020, 2008, 2012. It'll happen again. But if you're 25 or 35 or even 45, you're not investing for 1 year. You're investing for 30 years. And over 30-year periods, stocks have never lost money. Not once in the history of the market. The safety of bonds is an illusion for young investors. You're protecting yourself from short-term volatility while guaranteeing long-term underperformance. Unless you're within 10 years of retirement, you should be heavily weighted towards stocks. If you're under 40, you should probably be 100% stocks. The risk isn't in holding stocks. The risk is being too conservative too early and running out of time for your money to grow.